Well, Wall Street took a breather yesterday, but the real action was still waiting after the closing bell. Hey everyone, it's Thursday morning, July 23rd, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella, here to break down yesterday's market action in just 2 minutes. Quick note before we dive in. Today's episode is brought to you by AMF Capital, Asset Management Frankfurt. Learn more about our funds and strategies at amf-capital.de. All right, let's get started. U.S. stocks finished slightly lower yesterday as investors waited for quarterly earnings from Alphabet and Tesla, while tariffs and higher oil prices stayed front and center. The Dow Jones Industrial Average finished just below the flat line. The Standard & Poor's 500 slipped 0.1%, and the Nasdaq Composite lost 0.5%, giving back part of the previous day's gains. After the market closed, Alphabet and Tesla kicked off earnings season for the Magnificent Seven. Alphabet delivered strong quarterly results, but investors focused on the company's plans for higher capital spending, sending the stock lower in after-hours trading. Tesla was also in the spotlight as investors looked for updates on spending tied to its automation strategy. Elsewhere, Supermicro jumped after reporting a record order backlog for its artificial intelligence servers. IBM also released results after a difficult week that had already weighed on its shares. On the policy front, President Trump signaled that temporary global tariffs could soon become permanent. That includes a possible 100% tariff on imported generic drugs, while a new 25% tariff on goods from Brazil also took effect yesterday. Meanwhile, oil prices continued to climb as the conflict involving Iran remained in focus. The United States carried out its 11th consecutive night of airstrikes, and lawmakers were told that the war has now cost roughly $37.5 billion. All right, that's it for today's Capital Markets Quickie. If you found this helpful, hit subscribe and stay in the loop. See you tomorrow morning.